If you want your offshore bank account to help you reduce taxes, there are 3 strategies that you can use right now. And they don't require millions of dollars, fancy lawyers, or expensive offshore companies or trusts. Instead, they're freely available to anyone who chooses the right banks and the right jurisdictions, even people like yourself living in high-tax countries. And yes, these are the same strategies that our wealthiest clients use to reduce taxes and maximize their profits every single year. But before you test these strategies for yourself, make sure you talk to a qualified tax advisor, because like anything, tax strategies are nuanced and can vary based on your situation. Now, with that out of the way, let's dive in. Strategy number 1, Lombard loans. Now, depending on where you bank in the world and the type of bank that you're dealing with, you might know this by a slightly different name. Americans, they typically refer to this as securities-based loans or asset-backed financing, while in Europe, the term Lombard loan is more commonly used. But at the end of the day, it doesn't matter what you call it, because what we're talking about is unlocking liquidity from existing assets without triggering taxable events. And how it works is pretty simple. You borrow against your existing portfolio, which can include stocks, bonds, deposits, even crypto that's held with an offshore bank. And this strategy is attractive for 3 main reasons. First, it can provide immediate liquidity at very low rates, usually in the range of 1 to 3%, depending on the currency and the assets that you're looking to borrow against. Now, the second reason is that it doesn't trigger any capital gains tax because no assets were sold. And third, it gives you access to flexible capital. Basically, you can do whatever you want with the money because it isn't earmarked for specific purposes. Now, in a recent video, I did share an example of a wealthy Canadian living in Canada with a Swiss bank account. And one of the 4 reasons that this Canadian decided to bank in Switzerland was to access this sort of financing at very attractive rates. Now, Lombard loans, asset-backed financing, it's a common strategy used for everyone, from small business owners to the wealthiest people on the planet. But depending on where you live, you do need to be careful about what you do with your money after you receive the loan. And that brings us to the second strategy to reduce taxes via offshore banks. Strategy number 2 is leveraging international tax treaties. Now, tax treaties are one of those things that are rarely talked about because they're complex and they're nuanced, and most people don't want to do the work to understand them. But they're extremely important because they can have a huge impact on your finances, and when used correctly, they can dramatically reduce the amount of tax that you end up paying. And do you know who's really good at helping you navigate international tax treaties? International banks and seasoned offshore bankers who deal with clients from all over the world. And that's because these international treaties impact every single decision that these offshore and private banks make for their clients every day. From deciding where to hold investments, which types of investments to buy in certain jurisdictions, where to domicile client accounts, and even which stock exchanges to use when buying securities. As a quick example, let's say you open an account in Switzerland as a foreigner and place your cash in a fixed deposit. You're going to get hit with a 35% withholding tax on those gains, which is crazy. But your Swiss banker, like a lot of offshore and private bankers, isn't going to let that happen to you. Instead, they know if you book that fixed deposit in a different jurisdiction, say the UAE, a country with 0% withholding tax, and then deposit those gains directly back into your Swiss account, you'll avoid any withholding tax at all, 100% legally. And before you say, well, why not just bank in the UAE? It's because the UAE imposes unique inheritance laws that frankly make banking there unattractive if you're not a local or interested in subjecting your family's wealth to local customs. But let's look at another example. Let's say you want exposure to the US economy, and you're a foreign non-resident living in a popular residency jurisdiction, a place like Panama, Singapore, Malaysia, or the UAE. Well, in addition to being popular residency jurisdictions, these countries have another thing in common. They don't have tax treaties with the United States. So if you buy and hold securities that pay out a dividend as a resident of one of these countries, you're looking at a withholding tax of 30%. But if you're buying through an offshore bank, you're going to have options. Your banker can help you navigate more attractive rates by leveraging international tax treaties. For example, something like an Irish domiciled ETF listed on the London Stock Exchange can cut that withholding tax in half. And these are just 2 very basic examples. But let's say you don't have a few million to invest, you don't want to make a deposit in Switzerland, and maybe you don't even want to invest in US dividend-paying stocks or index funds. No problem, we still have more strategies on how you can use offshore banks to reduce tax. And this next one is never discussed, but it's super straightforward, and you don't need a massive deposit to make it work. But before sharing this next strategy, I do want to point out that there are many more strategies available, ranging from structures like private foundations in Liechtenstein, Austria, or Panama to trusts in the Cook Islands, Cayman, or even the US. And there are situation-specific options like captive insurance companies or offshore IP holding companies too. But these entities aren't easy to bank. Even if you have a lot of money and you set up a Cook Islands trust, maybe you throw a Nevis LLC underneath, you're still going to struggle to find banks that are willing to onboard you, unless you know which specific banks are going to cater to your profile, as well as the profile of the entities that you're using. So if you want me to cover any of these structures and how to bank them, just comment the specific structure that you're interested in below, and we'll work on getting a video out in the next few weeks to cover that topic for you. Okay, now the next strategy is real estate financing. And before you ask, how can investing in real estate help me reduce taxes? I just want to point out, I'm talking about how you can continue to grow your wealth in a tax-efficient way using tools that are available to you through foreign and offshore banks. And one of the best and easiest tools that these banks offer is real estate financing. And yes, I am talking about accessing mortgages as a foreign non-resident, meaning in countries where you're not a citizen, you don't live, and you maybe don't even have any ties. But it's still possible to qualify for mortgages in certain countries. Places like the United States, the United Kingdom, parts of the European Union, think Portugal, also in the Channel Islands, then there's Monaco, Switzerland, and other countries as well. And frankly, the terms being offered to foreign non-residents when it comes to buying real estate in these jurisdictions can be very attractive. Surprisingly low down payments, market rates, and qualifications based on income generated by the property, not your income domestically. In other words, you don't need to be an ultra high net worth individual to make this happen. You just need to be able to make the down payment and know which banks to talk to. So again, what does this have to do with taxes? Well, if you qualify, the income that you generate from the international real estate will then be used to pay off the mortgage with the bank, which will then offset some or even all of the related taxes. And this may seem like a no-brainer, but I'm not talking about buying real estate in your home country. I'm talking to Argentinians and Brazilians who want an income property in Miami, Canadians and Brits who want a second home in Portugal, even Americans and Germans who want to build a rental portfolio in major cities in the UK, or any non-resident who wants to acquire property in the US, Europe, the UK, and beyond. All of these options are available to you through international and local banks if you know which banks to talk to and what it takes to qualify. And obviously, certain banks are going to be better positioned to help you than others. In particular, private banks in reputable jurisdictions like Switzerland, Monaco, the Channel Islands, the United States, Singapore, and in many other places will be able to offer more support. And in this video over here, I break down an actual case of a Swiss private banking client, the specific strategies and tactics that he is using as someone who is living in a high tax country to grow and protect his wealth in a tax-efficient way. So if that sounds like it's something that could be interesting to you, give that a click and I'll see you over there right now.